these days is that nobody does their accounts manually. Okay, yeah, nobody still uses manual cash books and manual ledger cards and all the rest of it. Okay, everybody really does it on computerized package. Whether you're a small business where you're probably using something like Sage or Zero or QuickBooks, something like that, or whether you're a really big organization, you're probably using something more like SAP or Oracle, okay? But fundamentally, all the kind of accounting packages and software that's out there, at its heart and at its core, what it's doing in the background behind the scenes is fundamentally the same. And so this little section here is just trying to point out that, right, what we've looked at in this chapter these days is maybe slightly false, or you're probably never really going to see or do, particularly in real life now, because the computer just does it all automatically. Okay, so we spoke about books of prime entry being over or undercast, so that when you get the sales day book or the purchase day book, when you add up the total of all the purchase invoices that day and do a double entry, okay, you might add it up incorrectly. Well, look, if you've put all of that into the computer system adds it all up, and it doesn't do it incorrectly. There are some things computers are extremely good at, some things they're not. Independent thought, yeah, computers aren't great at that. Doing a very repetitive process over and over again and getting it right 100% of the time, they're very good at that. So a computer package will add up those invoice values correctly. It will not make a mistake adding that up, okay? So stuff like that, instantly, that's not really possible in a digital bookkeeping system, okay? That wouldn't be added up properly. Again, what you actually find with a lot of packages is, whilst we kind of said, look, manually, it was a real pain in the neck to actually do a double entry on every individual sales or purchase invoice, okay? Because it just would take ages to actually, there's a sales invoice, go and do a double entry for it, okay, write that down. Come back, oh, there's another one, do the same thing. And so it was always easier just to literally write all the sales invoices down and just do a single double entry kind of at the end of the day for all the invoices that day. For a computer to post a double entry on an individual sales invoice takes it like a nanosecond. So actually, you may find that it does post each individual invoice separately because it can do so, and it can do so instantly, okay, in terms of what's there. Other things that the computer system automatically does for us, okay? It automatically transfers data from the books of prime entry to the ledger. So all that kind of, we might, there might be a sales or a purchase invoice and we might forget to update the customer or supplier account. The computer won't. That will happen automatically, okay? We might post the wrong number as a double entry into the control account, okay? Or forget to do it, or post it on the wrong side, or things like that. The computer won't. So actually, once you enter the sales or the purchase invoice, you don't need to worry about the double entry, okay? You don't need to worry about updating the individual accounts. As a human involved in that now, that requires you to, select the correct customer or correct supplier, possibly type in the amount of the invoice, depends on the system, okay? You might just, it might just be selecting kind of almost products that are on the invoice. It might be you need to type in the amount. But once you've done that and go, press go or print or save or whatever the button is, the computer will automatically do all this sort of stuff for you, okay? And that it will just fire that number out. It'll put it in the ledgers, it will do the double entry on it, and all that happens immediately, okay, sort of thing. And then finally, it will automatically reconcile the receivables and payable ledgers with their control account. So this is a very automated process now, okay? It doesn't actually require a lot of human interaction these days, okay? To be honest, these days it's kind of impossible to really do. In theory, you could, because in theory, if you did a double entry via a journal on a digital system, you could go, right, I'll put a debit or a credit to trade receivables or trade payables and record it in the like the ledger control account, and not go and update all the individual customer or supplier accounts. So theoretically, you could do it. However, most systems these days actually have thought about that and would stop you from posting entries that in the main ledger that then don't match the subsidiary ledger. So they'll stop you posting something directly to trade payables, trade receivables, and the control account without it going through the subsidiary ledgers, or vice versa. As a minimum, they will bring up some sort of warning message or this won't update the supplier accounts. Are you sure you want to post this? We've all seen those kind of messages, sort of stuff pop up on systems before. So it will either say, look, are you absolutely 100% that you need to post this or not? Or some will just go, no, we're not doing it. And say, cannot do this. It won't update the subsidiary ledger, and it simply won't allow it to happen. Okay, so it's just a bit at the end here, and it's just an awareness that you need to have of what we're trying to do with this unit and what the AAT want you to have an awareness of. In that it's great that you understand how this works on a manual system, because then you understand what the computer is doing in the background, and when you press save sales invoice, you actually know what it's doing, what double entries it's doing, what it's updating on ledgers, and how that all agrees. But it's also recognizing the fact that where we are now and where technology is, what we're kind of doing here, I suppose, from an exam land point of view, is a little bit artificial compared to what you would do in real life now, because in real life the computer will do a lot of the sort of work we've discussed in this chapter and does it automatically. Okay, so it's just having an appreciation of that. Hello and welcome to these online lectures. We're now moving on and we're having a look at something called the journal book, okay? And that's what we're going to be looking at in this area, and indeed just making a start on that in this lecture. Now, before we do that, just a little bit of a recap here on the flow of information, okay? Because it does, it's useful to remind ourselves of this, because that actually helps explain why we ultimately need journals. So this is nothing you haven't seen before, so you should be familiar with it, okay? But let's just have a quick reminder of what happens. So the idea is, when there is a transaction that takes place, we expect it to create some sort of source document, okay? Good example there they give us is, if there's a sale, you produce a sales invoice. Equally, it could be when there's a purchase invoice. So something like that, okay? Something happens, and there is fundamentally a source document that goes with it. It is those source documents that we end up entering into our books of prime entry. They act as a trigger for us that something has happened, and so we enter it into a book of prime entry. So if it's a credit sale, okay, then we would put that sales invoice through our sales day book. If it was a cash sale, we would put it through our cash book. Okay, same if it was purchases, credit purchase day book. Cash purchase, cash book, might be a petty cash purchase through the petty cash book. So having done that, it then gets entered into a day book. Now remember, it was the totals of those books of prime entry, okay, that we total up each day, and we then post via a debit and a credit. We do our double entry on, and that's how they end up in our general or nominal ledger. Okay, so at the end of each day, we go, right, there are all the sales we made on credit today. So, right, now let's sort of go debit receivables, credit back, credit sales. That would trigger us to do a double entry. Now, having done the double entry, okay, and having then started, well, not just that one, but all the double entries we've done over a period, what we're then going to do is make sure we balance off our ledger accounts, i.e. those T accounts. So whether that's the end of a month, a quarter, a year, all the the sales T account, we'll balance that off so all the sales get recorded, and we're like, right, that's the final figure for the period of our sales, okay, or our receivables or our cash or whatever the T account is we're balancing off. Again, and it's those balances, remember, that go into the trial balance to make sure we haven't done anything wrong. And from that trial balance, we can actually produce a set of financial statements. Okay, that's where we can produce things like our P&L and our balance sheet and stuff like that from. So that's the kind of the basic flow of information, which you should have seen before, and the way that kind of works. Now that's great. However, there is a problem with this, okay? And the problem comes all the way back up here, right at the very start. in that we are fundamentally assuming that there will be some sort of source document that is triggered at the start. And the massive problem here is that not every transaction that we need in our accounts will have a valid source document. Okay? Now, a good example of this is actually the irrecoverable bad debts, which we have seen previously. Because if you think, I am going to make a sale. So there will be a source document there in that I will produce a sales invoice and I will send that to the customer. If that customer isn't going to pay that, okay, for whatever reason, maybe they can't, maybe they're going bankrupt or in liquidation or whatever, I don't get a nice document back from them, okay, almost like a negative invoice, okay, or something made out, look, bad debt, please retain this for your references or for your file that this debt is now a bad debt. That doesn't happen. But we absolutely need to account for that bad debt, okay, and so this is the issue. Is that if you have a transaction that is valid and is legitimate and it needs recording within the financial statements, but there isn't a source document for it, how do we deal with it? Like that's fundamentally what we're trying to get to here. And the solution is that if we are dealing with something where there is no source document, but we do need it within our financial records, then this is where the journal book kicks in. Okay, yeah, so this is the whole point with this journal book. So we're going to use it for valid transactions in a period where there is no source document. That's ultimately what we're using it for. Okay, so there isn't a bit of paper, there isn't an invoice, okay, there isn't something we can tie this back to, okay, but we absolutely will need to record stuff down. Okay, now there are numerous examples of this, okay, probably the main ones we're concerned about in this unit will be bad debts, which we have kind of covered, opening balances, and payroll. Okay, so we haven't seen opening balances as payroll yet, particularly. We'll cover that in this chapter. Bad debts we have seen, okay, and we will kind of recap on that in just a second. There are other things, other things that you might come across and you may hear about at work and stuff would be something like depreciation. Okay, would be another one. Okay, now be clear, depreciation's not in this assessment. Okay, so you don't need to worry about it for this unit. You will see it in other units, but it's a very common one where we would do journals, and it's the sort of thing that you may well see or hear, or possibly even deal with at work. Okay, so that would be another good example of where there isn't a source document for depreciation, but we do need to go and account for it in a given period. So there's lots and lots and lots of things like that. Where we need to do journals. Some of you may have even heard of things like accruals and prepayments. If you haven't, don't worry. I said it's not examinable here and at this level, but it's things you might come across at work. So that's the idea with a journal book. That's what we're looking at. Now, the idea is, okay, behind it, there should be, it should be in a kind of book, you should keep a clear record of all journals. It's one of those things, if someone is going to maybe do something a little bit dodgy in a set of financial statements, or maybe put through transactions that are shall we say not 100% legitimate, often that's done through journals because there isn't the source document to back it up. Someone could in theory just produce a journal, post double entry in the accounts, and bang, it's in there. Okay, so there are things we would expect to see. So if we have a look at this, it just ties into to what's written below about the sort of things we are expecting to see. So first of all, I would expect journals to be numbered. Okay, so there is a very clear track record of all the journals and what transaction it is. Okay, so that way, if we need to, we can do a sequence check on journals and see whether or not any are missing or duplicated, things like that. So I would be expecting there to be an actual number on it. Now, in terms of journals, as I was kind of alluding to there, because in theory you could just post a journal and basically make up some very fraudulent transactions, or they might not relate to anything, we would expect some level of authorization over a journal. Okay, so the second thing we kind of expect to see there, just on the list of stuff below, is that authorization. So, a manager, a director, a partner, whoever it might be, should have oversight of the journals being made and effectively agree to them. Okay, now obviously because we're doing a journal, what we're trying to do here is make sure that we get a double entry going into our accounting system. Okay, in the same way we've done double entries from our day books and done debits and credits, we now need to do double entries from our journal book. So in which case, if we're going to do a journal, we clearly need to identify which accounts, okay, which ledger accounts we're actually going to debit and credit. So here we can see we're writing off a bad debt, so we're going to touch the bad debt expense account, the VAT control account, and our receivables ledger control account. So they are the actual entries that we're going to deal with, okay? And then you can see we've obviously got a debit and a credit, and so right, there is the actual entry where we're debiting that VAT expense 100, we're debiting the VAT because remember, if it's bad debt, we don't need to hand the VAT on this over to Revenue and Customs, so we'll debit that part, and then we'll credit receivables control because this isn't an asset anymore. We're not going to get this money back. So it clearly identifies for us the debits and the credits, okay, of what we're doing. Okay, now we also need to just total it up so we can see, right, because you might be doing multiple journals in one go, or there might be multiple bad debts you're writing off. Okay, so if there are kind of several things you're doing as one, okay, then we obviously need to know the total of that, so we can see there that yes, it has been totaled up, so we know it's there, and it does allow us to check that total debits meet total credits. Obviously a slightly important step when we're doing debits and credits there. Okay, so fine, we need to deal with that. So fine, we've got all that sort of stuff in there. Other things we will need to go and do if it's the kind of thing that certainly in the case like a bad debt, we need to make sure not only do we do a double entry in the system, we need to make sure we update the correct customs account. So that's why we've got a little memo here, okay, to say, look, in the actual receivables ledger, in that list of individual customer accounts, we need to go to C Olio, and we need to make sure that we record that one through as well. Okay, so we put that bit in. And then the last kind of crucial thing really that's in here, okay, is just the idea of the narrative, okay? All journals should have a narrative with them, okay, where you basically explain what that journal is. So for me, coming along and looking at this, okay, all right, here I might have probably got a fair idea from looking at the debits and the credits, but it's just a very clear look, this is what it is, okay? This is writing off C Olio's irrecoverable debt. So if I wanted to go back and I wanted to check this, if I wanted to audit it, or indeed if someone external, if an external auditor was coming along and looking at this, there'd be a very, very, very clear reasoning of, oh, okay, that's what it is, that's what this is for, and we can now check and go back and make this, make sure this is a legitimate thing, okay? So that's the sort of thing we expect to see on a journal. Now, the references, I probably should have said those, they just tie into whatever the actual account names are, and obviously you do put a date on it as well. Okay, so I know I haven't highlighted those bits, but obviously they are on there as well. Okay, so that's what a journal entry should look like. The written stuff just below it just explains what I've been talking about. Okay, so look at that again. In your assessment then, okay, what are we expecting to see? Well, typically the way it tends to be laid out is something like this, okay, and if you've got to make a journal, there will be an account name. Now, that's the kind of thing that it will be drop-down menus. We'll put a little thing there, so you'll just click the button in the on the computer. That will pull up a list, so you can then select what you think is the most relevant account name, okay, so, whatever that might be, whether that's VAT, let's say, okay, could be, or, if it is, I don't know, receivables control, whatever you think you need, just a couple of examples there, you'll select that off the list. The amount, you will obviously type that into the box, okay, so whether it's 100 or 500 or whatever the numbers are, you'll type that number in, and then again, you'll click your mouse to go, right, am I debiting or am I crediting, okay, so, you can fill that in when you're doing it kind of on the screen and doing the assessment yourself, but that's typically what it looks like. We would expect somewhere within the assessment that you're going to have to fill in a journal, okay? It is way more likely than not that somewhere you're going to have to do a journal, and that's the kind of thing you'd be expecting to be producing. Hello. Right, carrying on with the journal book lectures, and we've got here, how do we go and use a journal to basically sort out and enter some opening balances? So that's what we're looking at here. Now, in terms of this and opening balances, this is quite common. When you get to the end of a period. Now, if you're doing this kind of internally, that would tend to be every month, because what you'll tend to find is that most businesses will have like a month end, so they can kind of see where they're at the end of the month, and so they will need to make sure that any sort of closing balances from, say, the end of July are opening balances for August, and so on and so forth. If you're dealing with financial accounts, that may just be that you do it every year. Okay, so in terms of like the actual year-end accounts, then they might be annually. But what we're looking at is when we move from one period to another. Okay, and we need to make sure that there are some opening balances in there. Now, in order to do this, we need to be dead familiar and dead happy with our dead click. Should be by now. So remember, our debits, we're talking about our expenses, our assets, our drawings. And our credits, we're talking about our liabilities, our income, and our capital, okay? So it's the kind of thing, that's what we've got. So remember, that's what we're looking at in terms of what's there. Now, because we are ultimately going to do this via a journal book, we are going to be entering in multiple debits and multiple credits, okay? And so therefore, they would ultimately need to balance off. Okay, your debits and your credits would need to be equal to each other. Okay, as a journal when you're doing it. Just watch out in the assessment, because sometimes they might do it where it's like, right, do it as an entire journal, in which case, yes, your debits and credits will balance. Sometimes they might list it as just like an extract, and they say, oh, work out the extract of these opening balances. Now, if it's an extract, what they're saying is it's not the entire thing, and so therefore they might not, it might be impossible to make it balance. So you do need to know which is a debit, which is a credit. You're not necessarily just going to be able to sit there and work it out via a trial and error, unfortunately. Okay, so let's have a look at this illustration and see how this starts to work. So we've got here Hot Dogs started a new business called Puppy Fat Limited, and a new set of accounts to be opened. So identify the journal entry needed in the general ledger of Puppy Fat Limited to deal with the opening balances by basically choosing whether it's a debit or a credit, okay? And so that's fine, and it's just a case of going through and identifying what these things are. So it's like, right, if here I've got a bank loan, what would I need to do? Well, a bank loan, that's something I owe to somebody else, okay? It's a liability, okay? So following my dead click, that would need to be on the credit side. Cash at bank, okay? Well, look, we own that cash. It's therefore an asset, okay? So that I would be sticking on the debit side. Machinery and equipment, again, this is something we own as a business, are going to use for more than a year and stuff. So again, it's an asset. So following my dead click, that will be debit. Rent expense, well, as the name implies there, it is an expense, okay? So again, following our dead click, okay? So right, expenses are debit, so we'll put that on the debit side. And then finally, capital. Well, again, as the name implies, the following our dead click, capital is capital. So therefore, that needs to be a credit. Okay, so that's how we would enter them in. So, in the assessment, you would just need to click your in the appropriate box and put those ticks in. Okay, so it says we've got, just explains what I've just spoken about, the whole asset liability bit. There is our completed box, literally in the way we've just done it. Final thing they do is just go, well, look, let's add up the debits, okay? And if you add up the debits, you get 53,000. And then if you look at the credits and add up the credits, they also come to 53,000. So that would be a journal you could post, okay? Yeah, you could post that in its entirety as a journal, okay? Because you've got all the debits and credits you need there and the two things balance off, okay? So that's what we're looking at. That's how you would essentially do a journal for opening balances. That's the entire point with them. Okay, now what we then have, just following this look, is a lecture example. Now, to be honest, this lecture example, very, very, very similar. Okay, so much the same thing and the same logic. We've got Cool Cats Limited here, started a new business, Kitty Co, and a newer set of accounts to be opened. So, record the journal entries needed in the general ledger to deal with the opening balances and choose debit or credit. So, again, it's one of these things. Depends on how confident you're feeling, okay? Yeah, if you're feeling confident, pause this now. Have a go. Put down your debits and credits. Decide which ones you think it is, okay? If you're not feeling as confident, then that's fine. Not to worry, okay? And what we'll do is I will run through it anyway in terms of what's there. So, it's up to you. You can either pause this now or have a go yourself, okay? Or if not, just go through it with me. Okay, so let's have a look at this and what we've got. So first of all, cash. Okay, well, cash, this is something we own. So I'm going to say cash is an asset. And following my dead click, well, assets are debits. Okay, so I've got that there. Cash at bank, okay, and again, watch out because obviously it could be bank overdraft or it could be cash at bank. This is cash at bank, which means we own this, okay, we own that money, that belongs to us. So again, it's an asset, and as we just said, that is going to be a debit. Capital, well, no surprise here, following our dead click. Capital is, in fact, capital, obviously following the dead click there. So, yeah, that's a capital, so therefore on the credit side, okay, is what we would expect to see with that one. Fixtures and fittings, okay, well, again, this is something we own. We're going to be using in the business for longer period, more than 1 year. So, in fact, we've got it and we own it there. That is going to be an asset, so again, following my dead click, okay, my assets there, okay, are debit. Insurance, okay, well, insurance, this is an expense, okay, yeah, we have to buy it, we have to pay for it. We only get short benefit from it, okay, so it's a sort of period type item, so it's an expense. So again, following our dead click, okay, that would make it a debit balance as well, okay, so it's an expense. A loan from the bank, okay, well look, if we borrow money from the bank, we have to repay that, okay, so I owe that money or that loan back to the bank, which means it's a liability, okay, so following our dead click, then liabilities are going to sit on the credit side, okay, so a loan from the bank is going to be a liability. Miscellaneous expenses, well, as the name implies, okay, that is an expense, and as we just said, expenses following our dead clicks are a debit, so we'll put that on the debit side. A motor vehicle, okay, so a car or van or something like that. Well, again, we own this item. We're going to use it for more than a year, okay, so this is a non-current asset or fixed asset, as you might sometimes hear, okay, so but the point is it's very much an asset. So again, following our dead click, assets are debits, so we'll put that on the debit side. Office expenses, again, as the name implies, so these are all the short-term costs we need to run an office, okay? As the name implies, it is an expense, okay? So as an expense, then, following our dead click, we know expenses are debits, so that can go on the debit side. And then finally, rent and rates, okay? Again, effectively a period cost here of having some premises, whatever they are, office probably. So therefore, again, rent and rates, they are an expense, so that will also go on the debit side. Okay? So that's the sort of thing. Now here, because we're doing it as a full journal, we can actually add this up. Okay, now if you add up the two credit entries first, because they're much easier and there's only two of them, then effectively the 46 192 and the 20,000, if you add that up, you get a figure of 66,912. Okay, there. If you then go down and add up all the debit entries, okay, and all those ones, then again you should come out as 66,912. So could you post that as a journal? Yes, you could. Your debits and your credits would equal each other, and it would be fine to post that as a double entry there and as a journal. Now, certainly in real life, as I said, journals should always balance, okay? And in the assessment, that may well be the case. As I said, just be very careful. If in a question they do say, ask you to work out the extract of an opening balance journal, then if it's an extract, what they're basically saying is it's not the complete journal, and in which case you would just need to put the items in accordingly. You wouldn't be able to do that little cross check at the end and go, oh, do the debits equal the credits. Here, because it was a full journal, I am actually able to do that little cross check at the end and agree that yes, okay, the debits and the credits do equal one another. Hello, welcome back. Now let's move on and let's start looking at what journals we need to process for payroll. Okay. Now, it's the sort of thing that, before we get into this, just need a basic understanding of how wages and salary works, okay? Now, it's the sort of thing, if you ever think about your pay slip, at the top left-hand corner, you kind of get your gross pay. And then at the bottom right-hand corner, you get your net pay. And unfortunately, the figure at the bottom right-hand corner is nowhere near as nice as the figure in the top left-hand corner. Yet, it is the net pay in the bottom right-hand corner is the bit you get. And it's because of the way it works, in that what happens when someone is on a salary is, rather than make all of those individuals sort out their own tax and do a tax return and everything at the end of the year, what they do, certainly in the UK, is operate what's known as a pay-as-you-earn scheme. Okay, and so the idea is effectively that your employer will deduct from you your tax, your national insurance, things like that, and it takes it off you at what's known as at source, so effectively each month as your salary is due, automatically deducts it from your wages and hands it over to the government on your behalf. And so the point is that if the only income you have is a job with a salary, you don't need to go through the hassle of filling in a tax return every year, because all your tax is basically sorted out by your employer. But let's be absolutely clear, it is you paying the tax, okay? And that's why, your gross wage, that's how much you earn. It's just that you then have to go and pay tax on those earnings, okay? But it is very much you paying that tax, hence the fact it comes off of your wages and you only receive the net amount. Now, that's fine. Couple of things to realise here. First of all, wages, salary, yeah, basically the same thing. In the assessment, probably going to refer to it as wages rather than salary, but it's all the same thing. Other things to realise, the amount you earn, the employee earns your gross wage. Okay, yeah, so that's your gross wage. And actually, that employee, the gross wage, that is the cost to the company of employing an individual. Okay, yeah, so if I employ someone on £50,000 a year, that costs me, the company, £50,000. Okay, it's not what that individual will receive. Okay, because the idea is the individual receives the net wage. Okay, so the employee receives the net wage. Okay, but the cost to the company is the gross. Okay, put that in again and try and write that in there, something that vaguely looks like I might have done it in English. So the employee receives the net pay, okay, because the company has automatically deducted tax for you and hands it over on your behalf. But the real cost of the company is the gross amount. Okay, where they pay the cash to, some of it gets paid to your bank account, some of it gets paid to Revenue and Customs bank account, but that's irrelevant. Okay, so that's the whole point. Okay, yeah, is that your salary will be the gross amount. It's obviously not what you get to keep, and the cost of the company is the gross amount. So, few things to be aware of and bits of terminology. Okay, what we call statutory deductions, okay, otherwise known sometimes as compulsory deductions, i.e., ones that will be taken off you and there's no choice over. So, first of all, income tax, okay, otherwise known as PAYE or pay as you earn. Okay, now that is mandatory. Okay, that if for any business that employs somebody, you have to deduct tax from them. Okay, and there's all the, I'm not going to get into all the detailed tax rules about how much you need to deduct. Okay, but you ultimately do need to be deducting tax off individuals. Okay, and so that is a compulsory deduction. Okay, if I employ somebody, I have no choice but to take that off them. And also the employee national insurance contributions. Okay, so national insurance is basically just another tax. Okay, just slightly different rules and margins and everything on it. But again, you as the individual, you as the employee, pay the tax and pay the national insurance. It's just that your employer takes it off you, okay, at the point they're doing running their payroll, and hands it over to the government and to Revenue and Customs on your behalf, okay. But those things have to be taken off, okay. Yeah, it's not voluntary. That is mandatory. Your employer must deduct those things. Now there are then some voluntary deductions that may come off, okay. So things like pension. Now in the UK these days there is something called auto enrolment, which basically says the default position is you will be put into a pension scheme, and therefore will have an amount of money deducted from you each month for pension contributions, okay. However, you can opt out of that, okay, so hence the fact it is still voluntary. Although, to be honest, the vast majority of people who are employed these days will have pension contributions taken off them. They changed the law on this a little while ago, okay, but you could choose to opt out of the scheme, so it's not essential. So that's one you might do. And so that was just, so pension's very common. Less common maybe give as you earn. Okay, so there may well be a scheme set up where you choose to have some of your wages paid directly to a charity. Again, make charitable donations, so the employer might take that off at source. There may be some loans, okay, so maybe you've got like a government-backed student loan, okay, so if you went off to something like university, you may well have taken a government loan to do that, and the idea is the government then starts to deduct that, or the employer, deducts it from you on behalf of the government and pays it across to the government each month. Okay, so if you've got a student loan, there may be other types of loan. Okay, it may be a company loan. This is quite common with things like public transport. So if you get a train to work, say every day, you commute and get a train. Obviously, trains are quite expensive. If you buy like an annual season ticket, it's a lot cheaper than it is buying a ticket each day. The problem is a lot of staff members don't have necessarily the thousands of pounds they require to actually buy a kind of annual rail ticket. So what some employers will do is they will buy the ticket on their behalf and essentially treat it like an employee loan, and the idea is the employee will then have a monthly amount taken off them, or weekly amount if they're paid weekly, taken off their wages and salaries to basically repay the loan for that annual rail card. Okay, so it's quite a common reason why as an employer you might make a loan to an employee, so that can be taken off. And then potentially maybe something like subscription fees. Okay, there may be something, it may be membership of a trade union, or there may be some internal club or something like that at work, which again will be deducted off. Okay, so they are things that could be taken off you. As I said, the first two, have to be. Okay, that's part of the law. These ones voluntary, they may be. So just looking at this illustration, just goes to highlight some of the things and numbers we were talking about there, and just saying, look, if the gross wage for an employee is £1,000, actually that might be broken down. It's like, okay, fine, they earn £1,000, but then we need to deduct £300 of PAYE, so £300 worth of tax, £100 of employees' national insurance, and another £50 in pension contributions. Okay, so that's what would be taken off them. Now the idea is the net wage that will actually be paid out to the employee is their £1,000 salary less all those deductions. Okay, so we'll take off the tax, take off the national insurance, take off the pension contribution. So in terms of what the employee actually receives, the employee is only going to get 550 quid. That's what's paid out to them. But the cost or the expense to the business is the full £1,000. Okay, so just note that. Okay, so the cost to the business is the gross wage. Okay, where we happen to pay the cash to, the fact that some of the cash there, is going to be paid. I mean, basically £550 will be paid to the employee's bank account. Okay, effectively £400 for the PAY and employee national insurance will be paid to the government's bank account, and 50 quid will then be paid over to the pension company's bank account. But the point is, for me as an employer, okay, the cost of employing an employee there would be £1,000. Okay, yeah, it would cost me the full amount. The gross wage is what it costs the business to employ someone, even though that employee doesn't receive the full £1,000. Okay, so that's just how it kind of works there. Now, while I've said that the gross wage is the cost of the business, yes, it is, but that's not actually the complete and full cost to the business. Okay, there will be a little bit more. Because in addition to gross wages, okay, the employer also has to pay what's known as employer's national insurance. Okay, so there's two bits of national insurance. There's employee national insurance, i.e. the bit that the individual pays and gets knocked off their salary. There's then employer's national insurance, so there's an extra bit on top that the company has to pay for. Okay, so that's on top of gross wages. And the other thing that is very common, pension contributions. Yes, and if you follow things like auto-enrolment, under the auto-enrolment scheme, yes, there is an element of pension that the employee pays and gets deducted straight off their salary. There is also then an additional sum that the employer has to pay on top of that. Okay? So therefore, if I'm looking at the total wage expense, okay, that will go through a business and the cost of employing an individual, we can break it down into three things. Number one, the total gross wage, which is made up of net wages, PAYE, employers' national insurance, pension, and maybe any other deductions. But you've got the total gross wage, plus any employer's national insurance. That will be an extra cost for the business, plus any employer pension parts they have to pay. Okay, so yeah, for the business, there's the three things we're working out. We need to know what's the gross wage, what's the employer's national insurance, what's the employer's pension, and if we add those three things together, that will be the complete cost to the business of employing someone. Okay, and that's all this illustration here is really trying to pick out for us and saying, look, the gross wage for an employee is £1,000. Okay, so that's what we agree to pay them as a sort of salary. But on top of that, there is employer's national insurance of £250, and there is also employer pension contributions of £150. Okay, so right, in which case the total wage expense that you would need to make sure you've put into the accounts and will need to sit in my general ledger and my T accounts is actually £1,400. Okay, yeah, it's the £1,000 to the employee. Okay, although actually some of that will need to be broken down. Some of that £1,000 will be paid to the employee as a net wage. Some will be paid to the government as tax and such like. But it's £1,000 salary for the employee. There's the £250, employer's national insurance, £150 worth